All right, let's talk about material. So here's how we're going to conduct the class today. We're going to cover materiality, and then we're going to break, and the two groups, I think group 5 and 10, I said? Did I say 5 and 10? Are going to lead the discussion on Pinnacle Part 2, and we'll talk about it as a class, and then we'll finish up and talk about the audit risk model. Okay. Any questions before we get started? Okay, materiality. One of the reasons that I did not want to include materiality on the exam is because I think it, at least until we take the next exam, is because it is a pretty difficult concept to wrap your mind around. And I find that this chapter, assertions and materiality in the audit risk model, tend to be the most problematic. So I just wanted to make sure that we spent some time talking about it to really ensure that you get a good understanding of it. So if you think about in the audit opinion, one of the things that they say, one of the big bold statements, is that the financial statements are free of material misstatements. So if you think about when you worked on the part 1 of the Pinnacle statement, the Pinnacle case, and you did the analytical review procedures, you did trend analysis, and when you had to look at certain accounts and see, kind of identify things that were jumping out to you. And I do recall some people indicating, I can't remember which account it was, but the account had changed by $87,000. Is $87,000 material to most people? Material to you? I know it's material to me. Right? But what were you saying with that? I think not for very big corporations. Well, so Levette said not for very big corporations. How would you consider it with respect to Pinnacle? Once you read Chapter 9, and so you know a little bit about materiality, you have somewhat of an understanding. In hindsight, would you say that $87,000 was material to Pinnacle? And if so, no, and if yes, why? If no, why? Does anyone think $87,000 was material? So if there was a misstatement of $87,000 for Pinnacle, would you qualify the audit statement? Would you give them an adverse opinion, audit opinion? Would you conclude that the financial statements are materially misstated if there was an $87,000 error? That is a question. There's not a right answer. I'm interested in your opinion, your audit opinion. No one has an opinion? No? No one has an opinion? Over $1 million. Right, so if you look at their sales numbers, they're doing over $1 million in sales. So if you base materiality, at least the quantitative materiality amount on net sales, right, or then $87,000 is not material. It's not going to change your decision. Or let me ask other people, would 87, if you sort of found out that the company had an $87,000, would that change your decision about investing in the company? Natasha? Right. So Natasha brings out a good point. She says depending on what you use as your threshold in defining overall materiality, it could be material. If it's net income, then it is material, right? So again, so that gets to the point. It's important. That's why identifying the appropriate quantitative threshold for materiality is extremely important, because that 87,000 same company, but depending on how you define overall materiality, makes a difference. And that's driven by judgment. Judgment that auditors have to defend and have a rationale for, but it does make a difference. So let's talk about that a little more. So it's important to be able to identify what is material. What is that materiality number? So the application of materiality is an accounting standard, so you'll see that in the standard, and it's an important aspect of the accounting standard or auditing standard. I pointed out that it's a high degree of judgment because we had Natasha say, well, if it's net income, if I use net income as my threshold, then it's material, right? But if we use revenue as or net sales as our threshold, it's not material. So what's the right number, or what's the right benchmark to use? And that's where the auditor judgment comes in, and there's guidance that the firm will provide them, and the standards provide, but it is a judgment call. It's a basic concept of auditing, but it's, as I pointed out, an ambiguous concept. I don't know if I mentioned this last class, I get confused with class, but we talked about some of the initiatives that the PCAOB is involved in right now, and one of the things that they've released is this concept of changing, or they're seeking comments on changing the auditor's report and basically making it more transparent to users. So in identifying the different types of decisions that auditors make with respect to the audit process. So things like materiality, things like their risk assessment, identifying issues that came up as in the course of the audit and how those issues were resolved. And the point of this is creating, as I said, transparency for users and helping the users to understand more of the audit process. But one of the things that they, as I pointed out, that they're going to talk about, that they suggest auditors talk about, is materiality. And you could see where that would be problematic, because if you just throw out a number, right, somebody's going to say, wait a minute. So let's think about companies like Apple or Microsoft or GE. Those are, you know, huge, huge organizations with billions of dollars running through. So you can imagine their materiality threshold is pretty high. And so think about a normal user, right? An average user of the financial statements to see something that, you know, it's maybe $1 million is not material, or 500,000 is not material, right? So it's kind of big. How do you? People are going to want to know, well, why wouldn't that be material? How do you define materiality, and in what way can you ever consider that 500,000 isn't a material number? Because it's material to me as a user of those financial statements. So it's really ambiguous. And I remember reading reviewing a paper for publication in a journal, and these authors did sort of like a roundtable discussion, or something similar to what they do in marketing, where they go out and get consumer opinions. But in this case, they got together auditors, investors, bankers, and client management, like CFOs, controllers, finance directors. And they had these people come in and talk about the audit report and talk about the audit process and what their expectations were, what it meant to them when they saw an audit opinion, what they believed that the auditor did perform during the course of an audit. And materiality materiality was one of the things that they asked the question about. Focus group, that's what it was. And what was interesting to me was I wasn't surprised that users had totally, different opinions of what materiality meant. But what was surprising to me was auditors could not reach a consensus on what materiality meant, which is kind of scary, right? Because you expect that auditors of all people would understand this concept. But that just points to how ambiguous the concept is. So what is materiality? Materiality is an assessment made by the auditor of the tolerable misstatement of a client's financial statement. So in other words, given the financial statement, how much can it be wrong? How much can it be wrong and it not impact a decision maker? Okay. So what is the amount that we can go have an error and not affect the user's decision process? When we talk about it, we talk about the different stages of the audit. The overall materiality assessment is done in the planning phase, but it is done throughout. It is because as you go throughout the various stages of the audit, obviously you're updating your information. You find out more. Right. So it is subject to changing. The important part of it is it determines, because we're doing this in the planning phase, the objective is to determine the extent of the audit procedures that the CPA or the auditor is going to perform. That's the overall. Right? Because you want to look at certain accounts are not going to be material at all. So maybe the balance is insignificant. So they're never going to be, it's not going to be a material amount to the financial statements. So the auditor's probably not going to collect a lot of audit evidence. It's a low-risk account. So they're not going to collect a lot of audit evidence. But you can imagine accounts like accounts receivable or inventories. You saw that in Pinnacle. I think the accounts receivable trend showed that accounts receivable trended upward by 58%. There's no way that that's not a material issue for account for the auditor. Inventory had trended up by like 25–26%. Again, those things are significant. But then you look at another account that might, there was a change of 87,000. You have to evaluate, is that significant? And again, we saw that number could be different. That decision or judgment could be different depending on the benchmark that you use for materiality. So if the financial statements, if the auditor finds misstatements or errors that are over that materiality threshold, then they have to consider issuing an adverse opinion or going back and doing additional audit work. So when is it material? I think I said this. If it changes the economic decision of a user, then it's material. The judgment comes in as to what is that number that could change the economic decision of a user. So you consider publicly held companies, well, you have many users of those financial statements. So it's very difficult to say that this is the number that's going to affect every user. You don't know that. So there has to be a way of coming up with an estimate, a judgment of what's reasonable. So you're coming up a reasonable, knowledgeable user of the financial statement. Just quickly, the standards talk about materiality, and they give the auditors guidance with respect to materiality, but at the end of the day, it is a professional judgment. All audit firms have their own materiality guidelines. They will base those guidelines from the standards, right? Those guidelines will be adjusted quite possibly depending on the client. But every firm will have their own written guidelines with respect to materiality that their staff would follow. In terms of the judgment, it's preliminary. As I said, it's done during the planning phase, but you're going to adjust materiality, or it's always present throughout the audit. It affects both the amount of work done and the disclosures made or not made in the financial statements. And it's the auditor's responsibility to determine whether or not the financial statements are materially misstated. So the materiality is not something that the auditor negotiates with the client. The auditor is not going to say, oh, we think materiality is X, and the client will say, no, it should be more of this. That's an auditor's professional judgment. It has nothing to do with the client's judgment at all. I doubt that the auditors even share what their materiality threshold is or their materiality amount is on the financial statements with their clients. So if you think, why do you think that is? What would be the problem in sharing that information with your clients? Below that threshold, because they would know what you as an auditor would weigh, right? Think about when you worked on the auditor-client engagement, negotiation case, and you went back and forth. Did anyone, without you knowing about materiality at that point, now, given what you know now, did you approach your discussions with either the auditor or the client team with this concept in mind in terms of, did you look at the amount and the impact that it would have on the financial statements? And did you factor that into your decision process at all? Did the amount matter? I hear mumbling, but I don't hear. Go ahead, speak up. I want to visit you guys when you're staff auditors and see if you're just this quiet. Do you remember the case? Do you remember your discussions? Well, what were some of the things you considered? Did you consider the amount? Right. So you did consider the impact on net income, right? You consider, or profits, right? You considered the impact on that. And so I'm sure if the impact was that it's going to increase net income by $100, were you going to argue as vehemently for or against it as opposed to if it increased net income by $100,000? Yes, no? Oh, no, I'm going to say no more Friday classes. Okay, I'm going to recommend we not have this class on Friday because I think you guys are zoned out by Friday afternoon. Remember those participation points. So, right, $10 versus $100,000 would have changed your decision, right? Right, that's an economic decision. That's what we're trying to get at with materiality. Those are some of the things, obviously, that the auditor considers. They have to decide what is, that number that could impact the user's decision process. So, as I pointed out, the standard has guidelines. They provide the auditors with guidelines. Audit firms will use these guidelines or adjust it, but it is based on the auditor's judgment, and firms will have their own guidance for their firm. So we have the first part of the materialities when we're coming up with the overall materiality and the preliminary materiality judgment, and that's based on quantitative factors. So it's some percentage, somewhere between 3 and 5 of these different factors. It could be total revenue, gross profit, income before taxes, income from continuing operations, total assets, a 3-year average income. So that's going to depend. And the auditor, and it's not that a firm will pick one of these and use it for all their clients. What's going to drive their decision is things such as who's the intended audience, what type of client is it? If it's a publicly held company, then most people are fixated on income. So perhaps they would, in that case, they would use some percentage of net income, as Natasha pointed out in her thought process, right? So what if it's a brand new company, and so their income is, has been fluctuating? or they're just a company that, you know, they really move with the macro economy, and so they're impacted by that, so their income just fluctuates. In that case, maybe they use a 3-year average income. What if it's a startup company and they really don't, or an investment type company, right? So maybe then you use total assets. So the auditor, that's a part of understanding your client, their business, the intended users, and what makes the most sense, what's most indicative, okay, for that company. What's the most realistic basis to use for that company? So it is going to be company-driven, in addition to the auditor is going to use their judgment, but they're going to consider those kinds of factors. Right? So that's your quantitative. That gives you your overall preliminary materiality. So if anything, if you set it at 3% of net income, let's say, any adjustment or total adjustments over that amount, over 3% of net income, would be considered material. And the auditor would insist that the client make the adjustment. But the standards say you cannot just rely on quantitative factors alone, because there are qualitative factors that could drive management's decisions about adjustments, but also if the user is becomes aware of these, that might change their decision. So some of the qualitative factors that have to be considered would be things like, is the company close to violating a debt covenant? So you might find an adjustment as you're going through the audit, and that adjustment, based on your preliminary rules, is immaterial, quantitatively immaterial. But if making that adjustment would cause the company to violate their debt covenant, that's material. It now becomes material. Because think about it. If you lend the company money, you want to know if they are violating debt covenant. You want to have a peace of mind that they're not, the auditor or the company is not waiving or not booking adjustments just so that they won't violate debt covenant. A company, a firm, a lender is going to want to know if a company is close to violating debt covenant. So in that case, that adjustment becomes, that quantitatively immaterial adjustment becomes material. Another thing would be if that misstatement changes a loss to net income. So if by not booking that adjustment or waiving it, the company has net income, then that again, I as a user would want to know that the company is that close to being in a loss position, because losses matter to the users of financial statements. It sends a different signal. It might change your decision if you see a loss versus just, you know, a small net income. Break-even earnings, if it's management turnover. And the reason management turnover is important is because what you have if you have a lot of management turnover, you no longer have stability, right? So you have to evaluate, well, you know, maybe this is, you know, because we don't test everything, because we don't test everything, perhaps there could be another problem. Right? A user could care about that. Why do we have, you know, do we have a signal of greater problems because we do have this management turnover? There's some instability. High market pressures. You see this all the time when you look at publicly held companies. Analysts are following those companies. The analysts will give stock recommendations and projected or forecasted earnings numbers. Companies want to meet that because there's a cost to them in the market of not meeting analyst expectations. So companies try to manage that. You hear about publicly held companies having analyst calls, and you know, so they care about that. So if a company has high market pressures, to meet analyst forecasts, again, that matters to people who are investing. So that, again, would be another qualitative factor. And then things like high fraud risk or higher than normal risk of bankruptcy. All of these types of qualitative factors you have to consider. So this is when we talk about, some of these, if you think about it, are inherent risks, which we'll talk about a little later in the day. But all of these things suggest to auditors there's a higher risk here, right? There's more risk. And these are all inherent risk factors. So they could change the decision process of a user. So both quantitative is used to determine your overall preliminary materiality, and then as you find issues or adjustments or errors, you want to also examine those in light of the qualitative factors. In setting your materiality limit, the first step is step 1, which is your preliminary judgment about materiality. Then allocate that. So that would be, for example, 3% of net income. That's your overall planning materiality. You then take that number and allocate it to segments and usually it's done to the balance sheet account. So you allocate some number based on the auditor's judgment to accounts receivable, to inventory, to cash. And then the final 5 steps, steps 3, 4, and 5, is when you evaluate your results. So you estimate the total misstatement, the combined misstatement. So the misstatements in the segments, like accounts receivable, inventory, and you look at that total combined misstatements of all the segments, and then compare the estimated misstatement with your preliminary judgment on materiality. So steps 3, 4, and 5 represent evaluating your results. Yes. The total misstatements by each, so you would take the misstatement from for each segment. So the total misstatements you found in accounts receivable, total misstatements you found in inventory, for example. And then the combined would be on the entire overall financial statement. Okay, let me just explain Tolerable a little bit more. So the materiality threshold, as I said, is going to be based on those quantitative benchmarks. And they represent the maximum. So that's looking at the entire financial statement, right? Because if you're using the benchmarks, it's going to be 3% or 5% of total assets or net income. So that's your overall and it's materiality for that organization or that company. And so that's what you say, 5% of net. If we have a misstatement greater than 5% of net income, for example, that's considered material if we have misstatement. And as I said, that's done during the planning phase. But you have to look at aggregate. You have to look at misstatements in the accounts because you audit accounts receivable, you audit inventory. So you have some expectations about those accounts as well. So you allocate that, and that's what we call a tolerable misstatement. That's the amount of misstatement that you're willing to consider, or the auditor is willing to consider on an accounts level. Okay. You can have, typically, your tolerable misstatement can't be less than your overall materiality. I mentioned that materiality, you're usually allocating it to the balance sheet accounts. So you'll see it allocated, as I said, to accounts like accounts receivable and inventory and cash. And the reason is, if you think about any transaction that you have in the income statement, it has a balance sheet impact, right? Right. Okay. So it ultimately ends up in a balance sheet. So that's why it's normally done to the balance sheet. There are two types of misstatements, and I'm going to touch on this. We're going to go into this a bit more when we talk about sampling. But there are basically two types of misstatements: known misstatements and likely misstatements. And a known misstatement would be a misstatement, for example, you're auditing sales cutoff. So you're trying, in this case, the cutoff, remember the cutoff assertion, you want to make sure that all of the revenue that's reflected in the financial statement, that should be reflected in the financial statements as of 12/31 are in the financial statement. So you want to make sure that they're recorded as of 12/31. So let's say you're auditing that. That's what we call a cutoff test. And you look at some items and you find that an item that was recorded as of December 31st really didn't ship out until January 1st. Right? So that would suggest that that item should be recorded in the next year and not as of 12/31. So that's a known misstatement, because you did your cutoff test and you found that this is wrong. Another example would be a known misstatement would be you are doing the bank reconciliation, reviewing the client's bank reconciliation, you're tying it back to bank documents, and you find out that the client forgot to record a disbursement or a check in the amount of $10,000. That's a known misstatement. Like, there's no guessing about it. They didn't record it. Okay? A likely misstatement is when you are doing sampling. So, for example, or when you're dealing with estimates. Because estimates are just that, they're estimates, right? You don't have an exact amount. You have a judgment about what the correct amount would be. Same thing with sampling, right? You sample from a population, right? So if that population has 1,000 items and you select 20 from that population, whatever your results for that 20, you now have to extrapolate back to the entire population. So if you find an error, you have to determine that error so let's say you find an error of 1%. You apply that back to the entire population, and that will give you your likely misstatement. So whereas a known misstatement is just something that you know with certainty, there's no estimation involved. Okay, that's known. A likely is an error because you're dealing with sampling errors as well as errors dealing with estimates of like allowance for doubtful accounts or obsolescence reserve or warranty reserve. So the client has one number, you come up with another number, so you're saying, again, the case that you did, right? The audit team came up with a number for obsolescence reserve, the client had a number for obsolescence reserve, right? And so the adjustment or the possible error is a difference between what you as an auditor determine and what the client determined. So that's an estimate. That's a likely error. As I pointed out, if the estimated misstatements exceed the preliminary judgment, so it's over your materiality amount, the auditor can perform additional procedures, and so you see that likely with estimates. They might request additional information from the client and audit that additional information to get the estimates, or they could require the client to make the adjustment. If the client does not make the adjustment, then that's the auditor has to determine whether or not they're going to issue an adverse opinion, right? But usually it doesn't get to that. They somehow come to a meeting of the minds, or they go to the audit committee if the client is not willing to make the adjustment. So here's an example of how the auditor would go through this process. So you have the various accounts, and so the auditor, and this is in your text, the auditor had a preliminary judgment about materiality of $50,000. And that could be based on whether or not they looked at some percentage of net income or some percentage of total assets. But whatever their quantitative benchmark or threshold was $50,000. They allocated they looked at the tolerable misstatements in each of these accounts, cash, accounts receivable, inventory. And you'll note that the tolerable misstatement is higher than the $50,000. That is not a problem, right? It's just that it cannot be below $50,000. So in this case, that's just they examined each of those accounts or made a judgment about each of those accounts and determined that these amounts would be considered, if there was an error in accounts receivable greater than $20,000, that's material. So $20,000, $36,000 for inventory are considered material. Right? And you have to figure, the reason that you'll see the tolerable misstatement be somewhat, possibly could be higher, because you can have errors going both ways. Right? So they could cancel it out. So the important thing is that it cannot be below $50,000. So they allocated the tolerable misstatement. Then they went through the audit process of collecting evidence and determined, found these errors, or misstatements, a no misstatement in cash of $2,000, $12,000 in receivables, and $31,000 in inventory. So they have $45,000 worth of known misstatements. They also performed sampling and found 16.8 thousand of errors, so that their total error in this case is a combination of your known misstatement and your likely misstatement. So they came up with a total misstatement of 62.3, which is greater than the 50,000. So the misstatements are greater than the materiality limit. All right. So they're material in that case. So that's the process that they would go through. And again, they could decide whether or not they're going to do additional work to see if, especially on the known misstatements are known misstatements. So, but the estimates or likely misstatements, they might try to refine their estimate even more. You see. So just in terms of when you have likely misstatements, how you would allocate that. So when you have sampling, so in this case, there was an example would be you had a net misstatements in your sample. So you say you sampled accounts receivable or some accounts receivable, accounts to confirm. And in those accounts that you selected in your sample, you found $3,500 worth of errors or misstatements. The total sample, the total items you selected amounted to 50,000. You take that percentage by your total population value. So this would be the total value of, let's say in my example, accounts receivable. You apply that percentage to the total population, and that is how you come up with your estimated misstatement. We'll get into this more when we look at sampling, but that's just an example of how you would have to allocate or extrapolate the errors that you found or misstatements that you found to the entire population to come up with what your estimated misstatement is. The reason it's an estimated misstatement because you're not looking at the entire population. This is your best estimate based on your audit procedures. Okay, so before we get to risk, why don't we have the groups, and we'll talk about, have the groups present their findings, then we'll take a break after that, and when we come back, we'll finish talking about risk. So groups 5 and 10. So what I'll have group 5 do part A and B, and then group 10 to do C. Okay, are you ready? Group 5? Group 5? Yes. You can't talk to the class with your back to them. No, everyone should have the question, so yeah. So you're going to just deal with parts A and B. Well, you're going to discuss it because you have reason why you came up with it, right?
Yeah.
Okay. Okay, let me do a quick recap and then we'll take a 15-minute break. Okay. So parts A and B ask you to talk about, and I'll get into acceptable audit risk in more detail after we come back from the break. But what it asks you to do is kind of consider the 11 factors and think through which ones would have an impact on the auditor's risk, acceptable risk. So I think both groups and the feedback I got from the other groups in the class was that from an external user's perspective, it would be the fact that they have large amounts of debt and they plan to incur additional debt. And so remember last week when you did the trend analysis, you saw that debt was trending up. But what was an anomaly there? Does anyone remember the anomaly that you saw related to debt for Pinnacle from last week's case? What goes along with debt in the income statement? Right, interest expense. And do you remember what was going on with interest expense? Right, and interest expense was going down. Right, so that's because what are we concerned with? What's going to impact the auditor's acceptable audit risk? Because they're concerned about, they want to keep that risk low, that they issue a financial statement, a clean opinion, and it turns out that there's been a material misstatement. So that has a direct impact on the financial statements if there's something doesn't make sense with interest expense, considering that debt is trending up. Okay, and then we saw related to that they had some related party transactions, I think issue number 11, right, where, is it possible that they incorrectly, and this would just be a consolidation issue, right, that they incorrectly included debt from a related party in that number. So that's an error in the financial statements more so than fraudulent financial reporting. Okay. And then we also saw that they're thinking about selling one of their divisions, which means that there will be additional users of that information, or quite possibly buyers who are interested in buying the company are going to want to look at the company. They're going to have their own auditors come in, quite possibly, and so you have a second pair of eyes kind of reviewing what you've done. Or a hindsight, applying some hindsight to the audit process. With respect to the likelihood of financial difficulties, pointed out that there's constantly changing technology. There's concerns about the viability of solar, and then also the violation of the debt covenant because their ratio fell below 2.0. Right, but we also know that there's some from the trend analysis that we did in part 1, that there is some concerns that there could be some financial reporting issues with respect to debt. And then there are really no major issues that jumps out with respect to management integrity. And yeah, you do want to consider that there's high turnover in the internal audit departments. And what is that about? But on the face of it, management seems to be, there's nothing to indicate that management lacks integrity. So audit risk is likely to be medium to low. One of the reasons that you might rank it as medium is because of the turnover. So there'd be more risk that you'd rank it because of the turnover in the internal audit department, and it is a new client, right? So the auditor should do a much more extensive client acceptance review. I'm not going to go through each one of these, But I'm going to focus on number one because there were some differences across the groups in terms of what effects that would have on inherent risk. So for all of the other all of the other cases or situations, group 10, and I think the class agreed on how that would impact inherent risk. However, number one was quite different. The reason is there's no effect is, as group 5 pointed out, and Natasha, what's your group number? Well, Natasha's group pointed out, is those, and I think one other group pointed that, you don't have your name tag, so I can't, pointed out, is that it's kind of far in its future, right? It's 10 years from now. Yes, they don't have today, they don't have the expertise in the employees, but they have 10 years, right? They have 10 years. You know that there's this company, and I think someone actually pointed out last week, why would you buy a company that's not doing so well, is having financial difficulties, but they see some future in that company. So clearly management had some, objective or strategy that, this company has great upside potential. So we're going to take, some losses now, but because solar energy is the way to go, and there's going to be all these EPA regulations, it's going to make this company viable and more profitable because they're ahead of the curve. We realize that, we have the potential upside. So they have 10 years. They know that they're moving in that direction. So as of today in the financial statements, in the immediate future, that's not such a big deal because they're not producing solar energy now. That's what they're gearing up for. So the company has the opportunity to acquire it. Also, I thought the point about you don't know where you don't know the source of the newspaper article. And especially in today's technology-driven environment in the internet where everybody blogs and has an opinion, right? So it's where's the, is it coming from, industry trade magazine or, a government organization, something like that, something that's more reputable, we don't know. And it's an opinion. But the biggest thing is that it's 10 years from now, so it's not as though this is something that they're now fully geared up producing solar energy, and Pinnacle hasn't upgraded their expertise in this area. So that's really the reason that there's no effect on inherent risk right now. Any questions about this? So the other thing I want, and I think most of you did, is keep in mind that this case is building, so you're going to pull in information, and as you're assessing it, so part of assessing this inherent risk and the auditor's risk, acceptable risk, right, is thinking through that information that you gathered last week through your trend analysis and your analytical procedures, and remembering the relationships and how they could impact the financial statements. So you have to consider those as well. So keep in mind as you're going through each stage of this project that you're building on the information from the previous project. Yes? It's a judgment, and we'll talk about that. So, I weigh your judgment in it, okay? But when we talk about the audit risk model, you'll see that, right? The auditor can only assess that information. It's a judgment process. So for your group, you saw that as a problem. Even 10 years out, you saw it as a problem, right? Obviously the audit issues are a lot more complex than this case would suggest, but it just points out the fact that these are highly subjective professional judgments.